Okay, fine. I think I've got pretty short time, so let's get going. We at Pyrford, we manage the Cautious Fund. This is a conservative fund driven by asset allocation and focusing only on quality investments. In 2021, we delivered a return of, I'm just getting up on my screen so I can't read the small screen on the of a 3.35% in excess of the rather conservative benchmark we have been set. However, the contributions to return were very skewed. We saw a year where bond yields started to rise. As you've heard from some of the other speakers, inflation reared its ugly head, and that has led bond yields to push up. We think there's a long way to go in this, and we have protected the fund by having very short duration within the portfolio. On the other side of capital markets, equities continued to perform exceptionally well, driven by the massive infusions of liquidity that central banks have put into the system, and we believe that this has driven equities to excessive valuations. You can see the performance on the screen here. Bonds negative, but your portfolio significantly outperformed because of the short duration. Equities very strong, particularly pleased with our US equities, where we actually managed to outperform a sharply rising index. In terms of currency, it was a mixed performance against the US dollar. The more hawkish central bank areas like Canada and the UK led to sort of flat performances against the US dollar. That's important because those are the two biggest exposures in terms of unhedged currency positions against the US dollar. The real weakness against the US dollar came from the yen, which was down nearly 12%, and the euro, which was down 8% over the year. There you're dealing with much more dovish central banks who, for probably quite sound economic reasons, are very reluctant to tighten. It does lead them between a rock and a hard place as inflation is starting to rear its head there. Just really want to talk now about how markets are positioned, and really give a warning about some rockier times that may be ahead. Let's first take a step back to what has happened in terms of liquidity in the system. Here we have a sign of money printing, which is central bank balance sheets assets. And this is really quite extraordinary. Money printing hadn't been heard of before the financial crisis. That's changed, and banks suddenly decided this is a legitimate tool to have in their toolbox. However, its use over the last 2 years has exploded. Central banks have printed about $9 trillion in the last 2 years, as much money as they printed in the previous 12. And this is really quite extraordinary. This is the massive infusion of liquidity in response to the COVID crisis. And what this has done it has hugely distorted asset prices. Firstly, let's look at equities. We have seen equities move sharply higher despite the initial drop from as a result of the COVID pandemic. And that leaves us with price earnings ratios, valuations at a higher point than we were before we went into the COVID pandemic. They were already very rich before COVID even came along. Now, clearly they have dropped because there has been an earnings recovery. There was always going to be an earnings recovery, but the market has, in total, in aggregate, outpaced that drop, and that leaves us at a price earnings ratio of around 23 times for global equities, which remains very, very concerning when we look at markets relative to dividends, because there hasn't been anything like the recovery in dividends that we've seen in earnings. We are sitting at a 1.6% 2.6% dividend yield, markedly lower than 2.3 when we entered the COVID pandemic, and about half what the dividend yield got to in March 2020, when the pandemic was probably at its most scary. This upward move in markets has been driven by the US. Just get the slide up. This is Warren Buffett's favorite measure of valuation. This is the market capitalization of the S&P 500 relative to GDP. This is now standing at 3 standard deviations higher than its long-term average. This is incredibly rarefied territory, and an area that's really not been seen before, and is very concerning. We could show you all sorts of charts about the extent of overvaluation. We could show it relative to replacement cost value, relative to dividend yield. We could show the cyclically adjusted price earnings ratio. They would all tell you the same picture. Now, the growth in valuations has been led by technology sectors, growth sectors, and that is partly been due to the very low bond yields that have been available. Technology stocks, growth stocks, tend to be what we call long duration stocks. They don't make a lot of money today, but they do promise this big pot of gold at the end of the rainbow. And if you discount that pot of gold back at a lower discount rate, that is what can be used to justify some really eye-watering valuations. The problem here is that those bond yields are now starting to rise, which undermines that story. Just a lesson in history, we have seen this before. One of the great advantages of being as old as I am, with the grey hair that I've got, is I remember previous bubbles. I only vaguely remember the early 70s, but we see here the Nifty 50, which are stocks like Polaroid, Kodak, IBM. They were driven to huge premiums to the market in the early 70s, repeated in the dot-com boom. Companies like Yahoo, Nokia became enormous companies. Where are they now? But this time we have seen an even greater outperformance by technology, and we do think that this is very vulnerable. Now, moving on to bonds, I think I'm using up most of my time here, so I'll speed up a little. What we have seen is the resurgence of inflation on a global basis, and this has driven real yields in government bond markets from outrageous levels to frankly absurd levels. We now see -5% real yields being offered in the US, in the UK, and also in Germany. Initially this was dismissed, that inflation was simply a transitory phenomenon. I think that argument is now dead, and central banks are having to react to inflation, which is clearly far more sustainable. We have seen it come through into wage rises in many economies. There's a shortage of labor. We've seen commodity prices continue to go up. Those can obviously drop back, but we're also going to see the largest element of the CPI continue to rise, which is rent. This is a lagging indicator after house prices. House prices have moved sharply higher in the last year, and that will inevitably lead to rent going up. So that upward pressure on CPI will continue, and central banks are having to tighten, and tighten much more than the market expected to deal with this inflationary pressure. Now we see this as quite a vulnerable situation. Markets have been driven to very low yields, very high valuations by a combination of vast amounts of liquidity and exceptionally low interest rates. If those interest rates are going to start to rise, if that supply of liquidity, if the tap is going to be turned off, and indeed there is the risk that it may even be reversed with banks shrinking their balance sheets, I think that leaves risk assets in a pretty vulnerable position. Now, we have reflected that in your portfolio by reducing the equity weighting to 20% in order to protect the fund, and we've done that as a value manager when our trigger points were hit. So in summary, just to show you where the portfolio is positioned today, we have a lot of bonds, and you'll probably say, why do you have bonds? The reason is that they are very, very low duration. These are not bonds that can make you a lot of money, but they can't lose you a lot of money either. Remember, duration is a measure of bond price sensitivity to changes in yield. Very low duration bonds, their price sensitivity is very, very low. Long duration bonds are very, very vulnerable to rate rises and rises in yields. The equity weighting is low, and the emphasis of our equity positioning remains very much in Asia. This is the cheapest part of the world. It is also the most economically healthy part of the world, with good sustainable growth, and you can find some very, very high quality companies there. And that is a theme that we have followed for many years within this and our other strategies, the inexorable rise of Asia. I think my time is up now, so I will pause there, but very happy to answer any questions that you may have.
Okay, thanks very much, Tony. I mean, I think it's wonderful listening to a manager such as yourself who manages a multi-asset global portfolio, because you actually just hear so much about all the asset classes around the world. So I think that's been fantastic. But I just want to touch on a question which you almost kind of ended off with as part of your presentation, but specifically your bond positions. And I noticed your kind of 1 year modified duration is obviously quite low. So just in terms of how you position the portfolio to have that low duration, and as you mentioned about the risks of longer term bonds, yeah, maybe just if you can dive into that a little bit, please.
Sure. Yeah. I mean, duration, as I mentioned, is a measure of sensitivity of bond prices to interest rates. So at these very low yields and very low coupons, long maturity bonds have a particularly high duration. So a 30-year Treasury, UK gilt, German bond would have a duration of about 27 to 28 years. Now, what that means is that if yields rise 1%, you will lose about 25% of your capital. That's just the mathematical relationship, which is obviously a fairly catastrophic outcome. So you need to avoid duration in a rising yield environment. That's why we have kept the duration of the portfolio exceptionally low. As I say, these are not bonds that can make you a lot of money, but they can't lose you a lot of money. And this is the capital preservation emphasis within this product at work to keep powder dry and then reinvest into risk assets, whether they be equities or longer duration bonds, when better value is available. We are quite prepared to own long duration bonds. We did so. We owned as long a duration as you could actually achieve back in the financial crisis. The difference then was that you were being offered a real yield of positive 5%. Unfortunately, today you're being offered a real yield of negative 5%. So there is no value to be had. So you've got to keep away from that duration.
Thanks, Tony. Maybe one last question for you is just about, in your presentation, you spoke quite a lot about how richly valued equity markets are. And maybe if you can just please talk us through the sell discipline at Pyrford.
Absolutely. It's very, very important to have a disciplined approach to selling. I think my previous speaker was talking about, behavioral aspects of financial markets. One of the key mistakes that fund managers make is they fall in love with their winners. Everybody feels comfortable about stock which is continuing to perform for them. However, you have to keep an eye on the valuation. The way we do this as Pyrford is that we measure every stock according to what we call a value indicator, which is its dividend yield plus its growth in sustainable growth in dividends and earnings per share over a 5-year period. Now, if that sustainable growth can be maintained, it doesn't matter if the stock goes up because it doesn't actually get any more expensive. What you need to be very wary of are stocks that rise much faster than that sustainable growth rate, because they clearly become more expensive and the dividend yield starts to fall. So we measure this on a monthly basis against all other potential candidates for the portfolio, and if a particular stock is rising very fast, the portfolio manager has to explain to the entire team why he or she might want to keep it. And in the end, this has to come down to hard numbers. Investment management is about process, and when the numbers are telling you that a stock is no longer of good value, then you need to have the discipline to go out and sell it. May not be what you want to do emotionally, but it is very, very important to apply that discipline.
Thanks, Tony. Yeah, you certainly make my job sound very easy. So yeah, good luck to you and your team, and yeah, best wishes in these difficult markets.